This is On the Market, a Bigger Pockets podcast presented by Fundrise. What's going on, everyone? Welcome to On the Market. I'm your host, Dave Meyer, and we have a really cool two-part show for you today. We came up with the idea for this show, unfortunately, because two of the panelists and our friends on the show, James and Jamil, have gone through some unfortunate situations recently where they were victims of scams, basically. And we thought it would be a great opportunity to talk about these two unfortunate situations and learn what we can from them. And hopefully in that process, we can help all of you who are listening to this avoid working with some of the bad operators that are unfortunately present in pretty much every industry. And unfortunately, real estate is no different. So the way the show is going to work is we're going to start by talking about different types of operators in the real estate investing space and how to best vet them. So each one of the panelists is going to talk about one of their expertise and how they vet an operator that they work with frequently. So Kathy's going to talk about vetting syndications. Henry's going to talk about vetting contractors. James is going to talk about vetting lenders. And Jamil is going to talk about vetting wholesalers when you work with wholesalers. So there's tons of great information, really practical, actionable tips that each of them provide. And then in the second part of the show, we're going to hear from James and Jamil, who are both going to share a lot of details about the scams that they were unfortunately party to and involved in. And it's, it sucks, really. There's just really no other way to say it. They both experienced some tough stuff, but I really admire and respect and am grateful for the fact that they're willing to share their experiences with all of us so that we can learn from some of the situations they found themselves in. So stick around for this episode. It's a long episode, but that's because it's packed with good information. So you're definitely going to want to stay to the end. All right. Welcome back, everyone. We are going to be talking about how to vet operators. And again, we're going to talk about syndications, wholesalers, lenders, and contractors. Kathy, we're going to start with you and talk about syndications. This has been, at least I invest in syndications, and I think, the potential for not just necessarily scammers, but just incompetence in this space has been really widespread over the last couple of years. And we would love to hear your advice on how you insulate yourself from bad actors or poor actors, how you advise other, the people in the Real Wealth Network to do the same.
Well, the incompetency thing is what I would often fall for. So the lessons I'm going to share today are learned from experience, and they're really hard lessons, and it's really important to share because there have been scammers or incompetent people in real estate, not just over the last few years. It's been for centuries, but the last few years is probably where it really accelerated because of the internet. In the last euphoric state, which was 2005, 2006, there weren't some of these social media outlets where you could learn about things so quickly. So I think this time around, the information would get out faster. You would have internet stars overnight who suddenly were experts. And people fall for people that they see in the media. And the media now is pretty easy to produce. You do it yourself. So the things that I've learned, the big one is track record. Now, there's two sides to this, but I would say when going into a syndication, you want to make sure that somebody in the leadership team, somebody in the general partnership that's in charge of the investment has experience doing what they say they're going to do, or what the business plan says, that they have experience for not just a few deals and not just a few years. It's okay to do that. If you want to invest with someone who did one deal or no deal, and you just want to, you think the business plan looks good and you want to go for it, you just have to know that you're at higher risk. Doesn't mean don't do it. Just know that if someone only has a few years experience, they just don't have a lot of experience specifically in changing markets and changing economic cycles like we're in right now. I see people saying, wow, if you can't put your money in a bank, where can you put it? And I'm going, were you not around in 2008? I mean, it wasn't that long ago that we had bank failures.
Literally today we had bank failures.
Yeah. So it's like, what do you mean? No, that's why the government only backs $250,000. That's why I make my husband run around and put deposits in different banks. You shouldn't have more than $250,000 in any one bank, because that's all that's insured. And well, I guess that's changing as of today, where I think the government's going to come bail it out, which is probably great for the depositors. So just track record. If you really want a conservative investment, make sure that they've been through a few cycles, because then they'll really know how to handle these different situations, and they would know how to underwrite. A lot of people were underwriting as if we were going to have low interest rates forever, and that was clearly a unique situation, a pandemic-led low interest rate environment. And that was going to change. And if you had a 3 or 4 year deal, you'd better underwrite it with the possibility that interest rates would go up, and people didn't. I mean, that's what Silicon Valley Bank did. I mean, they were buying bonds thinking that rates were going to always stay low. So track record is a huge one. But people could put whatever they want on their bio in the PPM, the private placement memorandum or the operating agreement. They can make a pretty nice looking bio. What I ask for and what I provide whenever I offer a syndication is a resume. I want to show me everything you've done, show me how it went, what are the deals you've done, what were the returns, what was your role. So it's easy for me to say I've syndicated developments, but do I really know how to develop? I don't have that experience. My partners do. But could I go out and say that on a resume that I have development experience? Sure. So make sure you find out how involved they were in that position. What was their role? Were they, just the admin on that project, or were they really the lead? So again, get their resume and find their involvement in those positions. The next, I think, is to find out the fee structure and their salaries. Are in the syndication, is somebody getting a salary or taking high fees? Because if the project goes on for a long time, then those salaries and those fees are going to eat up any profit that there might have been. So the operators get paid, but you don't. In fact, you could lose your money. So I don't like to be in deals where there's salaries or high salaries. If, obviously people need to be paid, but ideally a syndicator should be well-heeled. They should have deep pockets that they don't need to take a salary. Fees, sure. There's reasonable fees that keep the lights on. But that's just, again, my personal opinion. And then skin in the game. Syndicators don't always, a deal can go really well where the operator didn't have their own money in it. But if they have a lot of their own money in it, that helps. That helps to know that they are well-heeled, that they do care, they want to see the investment go well, especially if their money's on par with yours. If it's an equity position that gets paid out when you get paid out, that can help. And then finally, it's just scaling too fast. Like, you can do one deal really well, and we've seen this over the years with property managers, with syndicators who maybe they did really well on one deal, and then they had to grow and hire more people, and they might be good at real estate, but maybe they don't know business, and they don't know how to hire people, and they don't know how to scale, but they're just scaling too fast and then hiring the wrong people, and the people they hired do a bad deal. I was just at the Best Ever conference with I won't say who, but a big group that is scaling very quickly. And they brought in somebody who just wasn't as good at due diligence as they expected. And they got a bad deal, so anyway, just scaling too fast makes me nervous, especially when people brag about it. I've just got 10,000 doors in the last 2 years. Well, Ken McElroy has 10,000 doors, but it took him 20 years. So how do you scale like that? And unless you've owned a business before, I can tell you personally as a business owner, I know my product, I know real estate, but I didn't know how to hire and manage. That's a whole nother skill set. So, when someone be aware of that.
I think that's excellent advice. I think the skill of identifying deals and even underwriting deals and managing them is a very different skill set, especially at the scale most syndications require, because it is more like traditional business operations than it is real estate. And I also want to say, like, just from personal experience, like when I first started investing in syndication, I felt like a little nervous to ask these types of questions. I don't know if you've had that experience, Kathy, like asking, like, are you taking a salary? Like you're questioning these people. But I found over the course of my career that syndicators, the good ones, like when you ask those types of questions. They want people who are going to dig into the numbers and who really understand it. They don't want people who are just going to throw money and then are going to ask silly questions later. They want people who know what they're getting themselves into. So I really encourage people to have a serious conversation with anyone they're going to invest with. And don't be afraid. And if someone is unwilling to answer those questions for you, that is an enormous red flag.
That's a huge red flag. I mean, in my syndications, since day one, I didn't know all the questions to ask because I was fairly new at it 14 years ago. So I wouldn't allow one-on-one conversations. I wanted everything to be in a webinar format or a Zoom format where smart investors could ask questions that maybe another investor might not even have thought about. And I would make it very public, and then I'd post those webinars on the investor page so that everybody could learn what are the questions I should be asking. And one person asked so many questions, I ended up hiring her. I'm like, man, you know so much about this. So people don't have to ask questions because she addresses it right off the bat. She was the one in the audience. I was like, oh no, she's going to ask questions I don't know. I'm just going to bring her on my team. So absolutely. I think more and more people are doing that where they're doing webinar marketing. And if you ask a question on that webinar and they don't answer it, pay attention.
Yeah, and that's a red flag in itself. We raise capital and we pepper our potential investors with questions because as an investment business, we need people on the same page as us. And we have minimum investments that we collect. And if you can't hit that threshold, you can't be in there. And it's just because we want a certain caliber investor with us. In case something goes wrong, you want the same like-minded people in the same foxhole as you. And the syndicators that will grab any dollar amount from anybody, that's a red flag because they need the money. Whereas we're doing an investment because we want to do it as a collective group, not just to make money. We feel good about the deal. We have money in the deal. People like-minded have money in the deal. And if someone didn't ask me a bunch of questions as an investor, that would be a red flag immediately if I wasn't putting money in a fund.
That's a great point. All right. Well, thank you both. This has been super helpful. We should move on. And Henry, I miss you. I feel like I haven't even heard from you all day. So let's go and talk about contractors. Can you tell us about how you go about vetting contractors for your business?
Absolutely, man. I think, this is one of the topics that I don't think get talked about enough with especially new real estate investors because it's such a key thing to need when you are buying under market value deals. Like you're buying them because there's some level of distress, right? You've got to go add that value. But it's one of the things that typically investors don't learn until they absolutely have to. And, I have all the same horror stories as all other new investors. I've hired contractors that have run off with my money. I've hired contractors that have, wanted a big upfront fee to get started and then didn't do what they said they were going to do. And so I've learned a lot along my investment journey. And so for me, one of the key things that I think new investors should be doing is I don't think people review existing work enough, right? Like, so a lot of new investors get a contractor name from like a real estate investment group, right? Somebody says, oh, you should work with, so-and-so's contracting, right? Go to Henry's Contracting. They did my last deal, right? And so they call Henry's Contracting. Henry's Contracting comes out and gives them a bid. And then they're like, hey, I like that bid. And then they start the work. They didn't go look at any project that company did or have any understanding of how they operate. And so what we like to do is, yes, I'll take recommendations, but I want to go see work. So I'll ask for addresses of properties and I make sure I don't schedule it. Like I don't want to meet you there. Just tell me where the addresses are of ongoing projects. I want to pop in when I want to pop in, right? I want to do those unscheduled, unannounced visits because then I can get a true sense for how they keep the job site, how their team works, right? Are the people there organized? Is the site clean? Are they respectful, right? How do they treat me when I get there? because these are people that are going to be managing your expensive renovation, right? If you're doing a 40, 50, 60, $100,000 renovation, you want to make sure that they are respecting your property. You want to make sure that they're doing what they say they're going to do. And so some of the things I take note of are just that. Is the job site organized? Is it dirty and disgusting, right? Because that could be a sign that if they don't keep the site organized, right, are they going to keep your money organized? Do they know what's getting done, what's not getting done? Do they know what materials are there or not there, right? So I keep note of those things. So always try to go look at current jobs. Do not schedule it. Show up when you want to. If they don't like that, like if they seem put off by that, it's a red flag for me. Like I'll say, okay, well then that's not somebody I'm going to work with, right? That doesn't mean that if they don't want to let me see it, they're a bad contractor. I'm just going off my best guess. My gut tells me that I should be able to move on and find somebody who'd be willing to let me see their projects.
That's great advice, Henry. Can you give us an example of a time like you've done that and how you approached it when you were actually talking to the contractor? Are they okay with that?
Yeah, absolutely. So we've done it several times. So both times I typically will just ask the contractor. I'll say, hey, do you have any jobs going on right now? And most of the time they just tell me. They say, yeah, I've got one at 123 Main Street. I've got another one at 456 Main Street. So yeah, go by, check them out and let me know. Right. I typically don't even have to ask if most of them are comfortable with it. The ones that I have asked have had no problem telling me, and the ones that have had a problem, we just moved on, right? So the conversation's typically pretty easy. I had one contractor that I used for several jobs where I pulled up. So I was driving for dumpsters, right? That's what they call looking for contractors. When you see a dumpster on the side of the road, pull over and ask them, yeah, driving for dumpsters, right?
That's a good one.
Pull over and ask them who the contractor is, right? So I pulled over because I saw a dumpster in front of a really nice looking house. And I said, hey, I'm looking for the contractor for this property. He was like, oh yeah, that's me. And I was like, that's great. Is this your project? He was like, yeah, it's my house. I was like, oh, it's your personal house? He was like, yeah, but we do contracting as well. And I was like, that's awesome. Is like, do you have some work I can see? And he was like, yeah, come on inside. And I, off the street, walked in this guy's house. He walked me through all the work he did on his kitchen. I'm like shaking hands with his kids.
Did you eat dinner?
It smelled delicious. I should have. I would have. I was open to it. But we did several projects together after that, right? And it all worked out well. So absolutely, the good ones have no problem with you seeing their quality of work and their job site. The other thing that I like to do is, I think oftentimes we're looking for, as investors, we're trying to like get the cheapest bid possible, right? We're trying to find the cheapest contractor, and like being cheap is expensive. So first of all, remember that. But second of all, like it's okay to sometimes pay for bids, right? Some contractors, when you say, hey, I want to, can you go out and give me a bid on 123 Main Street? Some contractors will come back and say, yeah, I can give you a bid, but I'm going to charge you, $60, $100, whatever it is, like a trip charge for me to go out and do that. And I used to be really put off by that. But what I learned when I actually did decide to pay for that is I got my bids faster than just when a contractor went out there for free. I got a more professional bid because I paid for that bid, right? I got a more professional looking itemized bid. There was less back and forth. And in all honesty, who would you rather have managing your $60,000 to $100,000 renovation? Bob's Remodeling, who showed up late, took notes on a napkin, right, and then took 3 weeks to get back to you with a bid, and you may like the price, or the contractor who charged you to be there, showed up on time, took notes, asked questions, and got you a bid turned around within 24 to 48 hours, and you didn't have to go back and forth about that bid because it was everything that you asked for, right? I would much rather have that person managing my extensive renovation. And so don't be afraid to pay for bids, because to me what that says is I value my time. I'm a business person, and I want to give you a quality bid. I don't just want to throw a number out there so you hire me.
Henry, when you're dealing with contractors, the one thing that I've noticed, and it's interesting that our show is called the Ponzi scheme episode, is that a lot of contractors actually run mini Ponzis, where they use the money from their next job to complete the job that they're working on right now. How do you go about making sure that the contractors aren't commingling funds between job sites?
Yeah, man, that's dealt with a situation like that recently. And so when I do my contracts, I typically do a scope of work, which is another tip I was going to give people. I do a very high level scope of work at first, right? Because contractors, the good ones, are busy. And not every contractor is willing to do every job. And so you could have a job that's too small for certain contractors. You could have a job that's too big for certain contractors. And so to save myself a lot of time, I'll do a scope of work. And that scope of work is very high level. It's just room by room what I want done. So kitchen, I want new floors, this color paint on the walls, right? New baseboards, hang new light fixtures, right? Very high level. So it's a room by room thing. And then I can send that scope of work to the contractor ahead of time. That way, if the job is too small or too big, I know on the front side, we're not wasting anybody's time. But once we get that bid back, Jamil, and we know what the line item cost, labor and materials is for each thing, we pay based on work complete. So we'll give a percentage upfront to get materials to get started. But there is essentially a checklist. We take that scope of work and we break it down and we say, this is what you get to get started. And then these 10 items must be complete and checked off before we release the next draw for the next amount. And so everybody has to agree and is signed off that is complete before we release the funds for phase 2. And so we'll typically break a job into 2 to 3 phases based on how extensive that job is. And we all agree on the front side to sign a contract to say, okay, we're not moving on to the next phase until we all agree that the things in phase 1 are done and signed off on. And so that's typically how we're keeping or making sure that at least what we're giving them is being spent on what's being done. Or if they go spend it somewhere else, it doesn't matter. They have to complete these line items before we'll give them anything else, right?
That was an important thing Henry just pointed out. A contract is not the same as a bid. A construction contract is where the contractor and the owner are on the same page with the same agreed upon terms. A bid does not reference that stuff. So that's very important that you contract every construction project.
Absolutely. So yes, another thing is scopes of work. You should do those high level scopes of work. It saves yourself a lot of time. It'll save the contractors a lot of time. I don't know how many times I've met a contractor at a job that he just didn't want to take for whatever reason, because I didn't just send the scope of work on the front side so they could evaluate it. Because you don't know how busy they are or what their crews are at, right? They could want your job, but their plumber's 6 weeks out, right? And you've got a heavy plumbing rehab, right? And so there's just sending that up front can help you save a lot of time on the back end in picking your contractor. And then red flags that I like to look for, again, when you're looking at those jobs, take note of the job site, make sure it's organized and clean. You want to make sure that, and then take note of the communication, right? If you are struggling to get your contractor to answer the phone, to show up on time, to give you a bid, to answer text messages, and you haven't started a job yet, I promise you that doesn't get better once you give them some money, right? Like if you're having trouble communicating on the front side, that's a red flag that's how the communication is going to go for the entirety of your working relationship. And once you throw some money out there, you sure as heck are going to want that phone to be answered or those text messages to be answered, right? And that communication to be there. And so I found that the contractors who communicate well on the front side are the best with being open and upfront and communicating on the backside, right? You don't want those contractors that never answer the phone or want to talk to you until it's time to get paid. Then one last thing to think about is a lot of contractors are going to ask for a percentage of that job up front. It's sometimes typical, but I've been asked for as much as like 75% of the total project cost on the first draw, right? To me, that's a huge red flag. Now, most contractors are typically going to ask for some level of cost to get started because they've got to go buy materials. So some ways to think about that are just use your gut, right? If you've got a $60,000 rehab and they want 30 to 40,000 of that up front, that's a good chance that they may not show up to do the rest of the work. They got half their money for doing nothing, right? So use your gut, right? But if they need a 20, 25% down payment, okay, think through what that is and then ask. Don't be afraid to ask. Say, hey, what do you need the $25,000 for? Typically, it's for materials. So you have a couple of options there. You can trust that that's true, right? Or you can say, well, what materials do you need? And until we build trust, how about I source the materials, or you get it on my pro account at, whatever big box store, and then they'll bill me. We'll get you all the materials. You get started, right? So that way there's some trust. I bought the materials. You did a little bit of the work. All right, now we can release some more funds. If they're not open to that, if they're saying, no, we need 50, 75% up front, then just leave. There's other contractors, guys.
All right. Great advice. Thank you, Henry, and everyone for chiming in on that. Couldn't agree more on the get what you pay for. I think that's a lesson we all learn very quickly into our investing careers. Jamil, let's move on to you. Let's talk about vetting a wholesaler. Where do you even start with this? It's
a really good question. Vetting a wholesaler is important, especially if you're a fix and flipper. You want to make sure that the person you're dealing with is giving you what they say they're giving you in a wholesale deal, in a contract, right? Because that's what we sell. As wholesalers, we sell contracts, we sell opportunities. And so is the opportunity really what they say it is? So first and foremost, if I'm buying a deal from a wholesaler, I ask for a redacted purchase and sale agreement, which is basically their contract to purchase the house. So I will never sign an assignment until I see the original purchase contract. And they can take out a few details. Like if they want to remove the seller's phone number and the seller's name, even the purchase price that they bought the house for, I'm okay not seeing that. Some wholesalers get sensitive. They don't want you to know how much money they're making. That's fine. You can take that off the contract, but I do want to see the redacted contract because what I'm really interested in is the additional terms of the contract. So I've been in a deal before where I have signed an assignment, and then I found out that I inherited a lease, and I didn't budget for a lease. I didn't want to have to get rid of this occupant or have to deal with the occupant in itself. And there was one where I had gotten into a deal where it was a 2-year lease. And so now I've got to deal with this whole situation. The other thing that I would say is before getting into a deal with a wholesaler, always view the property. A lot of wholesalers will try to get you to commit to deals sight unseen. That's a very common tactic for wholesalers. They create FOMO. They create this, you got to move on this deal before anybody else gets it. I don't have a lot of time. I can't get access to the house. You're going to have to make a commitment and wire in earnest money before you see the house. And I have been burnt in that same situation. Again, bought a house from somebody that we knew and trusted in town. They claimed the property was a 3-bed, 2-bath. We ended up buying it, closing it, and then finding out that it was a 2-bed, 1-bath. And it completely changed the math. So we lost significant money on that deal. The other thing I would look at is never buy a deal that is being transferred to you on a quit claim deed. So that's another thing that wholesalers will try to do. They will go and try to do a deal outside of title. And oftentimes the reason they want to do that is because there's a lot of clouds on title, or there's just an interesting situation going on with the chain of title and the title's not insurable. So they'll want you to do the deal by quit claim deed. Never do a wholesale transaction on quit claim deed. You will get burnt. The other thing I would ask a wholesaler is what's their volume? How many transactions are you doing on a month-to-month basis? Do you have any people that I can talk to that have bought deals from you? I would absolutely want to see that. The other thing is I would look at their wholesale list, and I would see and check other properties that they had wholesaled and seen where are those houses now? How do they look? Are their ARVs real? If your wholesaler is sending you a property and they're overinflating their ARVs, then you know that they're not an honest person, right? And you should be able to know an ARV and be able to understand what your after repair value is and not have to rely on a wholesaler's after repair value. If you are in this business and you're relying on a wholesaler's after repair value, pause and learn how to comp before you start spending money and getting involved. The other thing I would do is ask for a wholesaler's website. If you're a legitimate business, you should be online. You should have a website. You can't just be, a fly-by-night operation and not have any online presence. I want to see that you're doing business. And the problem is wholesaling is a very early real estate investing technique. So people don't have a ton of money when they get started, and they sometimes don't go and build a website. I think that that's not cool. You definitely need to have an online presence. I want to see what you've got. I want to see your inventory online. And then lastly, I would say Google the company. That's I know it sounds common sense, but look, if I had Googled the people that I put money in on the Ponzi scheme, I would have gotten some red flags ahead of time. I didn't do it. I trusted the people, and I should have Googled and should have read every page, like all the way to page 4, 5, and 6, because page 4, 5, and 6 is where the actual meat and potatoes of their unsavoriness was talked about. Because page 1, 2, and 3 had all their current social media posts and all the things that were really, timely about them and maybe more current information. But you want to see what somebody's done in the past. You want to understand the skeletons in their closet, right? And so Google a company, that'll give you some great details. You'd be surprised at how many folks will actually go to the internet and voice their concerns and their opinions when they've been burnt.
Wow, that's a great piece of advice. So when you're looking over a contract, do you recommend people get lawyers, or did you just learn to read these contracts yourself over time?
Again, I think on the safe side, of course, always seek an attorney's advice if you are unfamiliar with legalese, and it can get a little complicated. But these contracts are pretty standard, and especially if it's like a board-approved real estate agent contract, which I love. I love the board-approved real estate agent contracts because they're very fair. They're always written quite neutral. And so I tend not to overcomplicate or overthink those ones. But I do read every line. I do make sure that I understand the contract, and I do make sure that I understand my obligations. But yes, the other side of that is if you can't afford an attorney, one thing that's really interesting about title companies that a lot of people don't know is that they always have legal on staff. And you can actually ask your title company to get legal involved to help you walk through the contract because you have some questions. And they will. And it won't cost you any money.
That's great advice. All right, James, we would love to hear about working with lenders. How do you approach vetting any lenders you work with?
Yeah, and this isn't really, lenders really aren't the Ponzi scheme unless you are the lender brokering the money out. You got to watch out for them for sure. But one thing that has happened dramatically over the last 6 months is the lending space has changed rapidly, right? Rates have gone up, terms have gone up, access to money has gone up. And so what has happened for a lot of these investors buying property is they get commitment for a loan verbally, and then last minute it changes right before closing and the terms change. And it's being very detrimental to a lot of investors because they have to double their down payment size, their rates and their points change right last minute before your closing, which can dramatically affect your deal and the profitability of your deal. And so things that you want to do when you're vetting these lenders right now, because, one thing that investors need to remember is most consumer protection rules don't apply to us. We're not protected. This is commercial loans. And so vetting is so important. So things that I like to do when I'm talking to a new lender is, what are their contingencies for funding? We own a hard money company in Washington. We fund in our backyard. Interest funding. We do not have any subject to appraisal. It is all underwritten in-house. It is myself or my business partner's call 100%, and we have nobody that's going to trump us. And so that's a committed deal. So if I'm talking to a different lender and they're subject to appraisal because they want to fit inside the box for whoever they're going to sell their note for, that means whatever they told me can change rapidly. And so you want to know, what are their actual terms for funding? Does it need to appraise? Is your debt fixed? That is a big deal right now. I've been seeing a lot of flippers, or I'll be talking to them, like, I was actually talking to a lender that loans a lot of money to flippers, and they go, we're still lending at 9.5% right now, which is low for hard money in today's space. But and I go, well, how does that work if it doesn't appraise out? Because I also know they sell their notes off. They had a clause in there that if it didn't hit the future market value according to a third-party appraisal, that their rate went from 9.5% to 13%, and 2 points automatically got charged, because then they have to dispo that loan out to somebody else. That is detrimental to an investor, and a lot of flippers don't understand, and you got to read through these terms and conditions, because if your deal switches 3 points on your rate over a 6 to 12 month period, you can go in the red really fast. And so the other thing you want to look at is, as a lender, a lot of us are doing heavy value add, heavy construction. What is the issuance of their construction funds? Is there verbiage in there? For us as a lender, hard money, I say there's two different types of lenders out there for bridge financing. There's hard money, which are guys that will issue you the money themselves. They have control of that capital. Then there's the soft money, which are guys that broker loans out to big note buyers. And they're two different things. The soft money guys have a little bit lower rate, but they come with all these conditions. And so you have to watch out for these construction draws. What's happening right now is these soft money lenders will say, yes, I will give you your $100,000 loan to Jamil, and we're going to issue you this money over this draw schedule. But there's a condition in there that if the loan to value drops, they won't issue any more construction funds. Even though they've committed that you need that money to stabilize that asset, if the loan to value drops below that, they won't issue you the money, and you got to come out of pocket with those rehab dollars. That is also detrimental to your deal. It can affect your cash on cash return. You might not have the liquidity. You can get yourself behind on payments because you got to come up with the funds otherwise. And so really get these terms specified when you're talking to lenders. I always want to know who's actually funding me the money. Is it a shadow company that's brokering the loan out, or is it guys with the actual capital? Those are two different types of lenders, and you can ask those questions. Most of the time, they're not going to tell you those answers, but you can look at how, then you go into what are your conditions? Does it need to meet appraisal? How does your construction draws work? What are their processes? Because those things have to be built out, and depending on their processes, my red flag always is, if they say, well, we send out a third-party construction team to review it. As a hard money lender in Washington, we review it all ourselves. We have people on staff that go look at this stuff. I don't want a third party to interpret a construction site. So that will tell you who you're working with. Because the thing is, as an investor, hard money costs more than soft money. It's usually 1 to 2 points higher on the rate. But if it can help you get that project done, you want to go with your hard money guy. And the thing is, you want to know this up front. You don't want to know after you bought the deal. Because if you know it up front, you can buy that deal cheaper to offset the debt cost. So when you're interviewing these lenders, really lock in your terms. Is there any variance in those terms? Can they switch things? And if they can, you want to lock in those terms. Don't buy anything on variable rates right now. It is not going to work in your favor.
How would you, James, advise people who are new to this, who are trying to get their first loan? What do you even look for? You're talking to probably a dozen lenders every time you do a deal. Mm-hmm. How should people even find good lenders to approach in this type of environment?
So the best thing you can do is find a backyard lender. Guys that are local, like Intrust Funding, our lending company, we only lend in Washington State. That's all we lend in. That's why we have full control. If I was lending out in Arizona, that's going to be an issue for me. I don't know the market as well. I don't know construction costs as well. And so that becomes a riskier loan. So find people in your backyard is the best thing you can do for a lender. The second thing is you can also look at private lenders, not just commercial. A lot of these bigger shops, they're trying to deploy as much money as they can on the street nationwide because it makes their company more value, and they're working on small yields at this point, and they're just trying to spend as much money as possible. Your backyard lenders or your private lenders in your backyard, they're going to understand you as a business, and they're going to work with you more business to business rather than just, do you fit in my box to lend you money or not? So look for your guys that are local.
All right. Well, thank you to Jamil, Henry, Kathy, and James for sharing their expertise on how they vet those operators. We're now going to go to the second part of our show where we're going to hear from first Jamil and then from James about how they found themselves involved with scams and what they learned from those experiences.
Yeah. So I just learned that the perpetrators in my investment have now been charged by the CFTC.
Sorry, what is the CFTC?
Oh, it's a regulatory body, much like the FTC or the SEC. They're a governmental agency that it basically is set up to protect consumers against fraud.
Great.
And so their job is to make sure that people aren't selling illegal securities, that they're regulated, that they have licenses, and that if they're raising funds from the general public, that they do it in the appropriate manner. And so this situation happened. I would call this more of an affinity Ponzi scheme. So how it went down is, Pace, Morby, and I were at a mastermind of very well known people in our industry. And after the mastermind, one of the attendees called Pace and I over and told us about this incredible investment that they were in that was generating 1 to 2% returns a day. And, you know, right away when you hear stuff like that, you know, the red flags go right up. But we're talking about people that we know very well. And again, you know, it was framed to us in a way that we were almost being shamed for not realizing that there were better returns available in the world, but we had been just so our mindsets were so broken that we didn't believe that anything better than 10 or 15% a year or 12 to 15% a year was actually real, right? And so because of that, our initial spidey senses were kind of like let down, and we listened to the rest of the pitch. So this individual shows us an account with $650 million, and he said, "This is the account that I've been money has been placed in to buy my trading bot." So this was the scam or whatever was, there was this savant trader who was trading US dollars against gold and was incredibly gifted at timing the market. And he called it front running, which is a very legal thing to do. How it works is these high frequency traders have these computers that are able to monitor when large institutions are placing orders for or selling gold. And because they're able to know when these orders are happening, they can place their orders and follow whichever direction these institutions are in. And it's completely legal, and you know, there's nothing wrong with that. If you have a computer that's able to monitor that and track it, then good for you. And so we thought we were getting involved in something like this, and also that there was some technology or an AI that was involved in also timing the market. So we get in, and I started to the tune of $500,000, and immediately start seeing, and again, the returns I wasn't able to realize any of the returns. I hadn't pulled any money out, but I was getting emailed daily statements, and the 2%, 1 to 2% was happening. And so I'm getting really excited, right? Because I'm seeing that a $500,000 investment, you know, at the end of 30 days, it's 20 trading days, right? So we're talking 20% in a month, right? Like that's phenomenal. I've never seen a return like that. And, you know, as a real estate investor, I'm making 20% a year, but I'm doing the work and I'm breaking my back to do it, right? So I'm thinking, wow, I can get the returns that I'm getting in a year on my money in a month. Like this is fantastic. So I double down and I send in another $500,000, and Pace does the same, right? So we're both into this thing for $1 million now. And that's where everything starts going wrong. So a couple months later, I put in a withdrawal request to I wanted to test $100,000 withdrawal. So I have $1 million in. It says now that my $1 million has grown to $3 million. And I'm you know, now I want to pull my principal out, right? So I first take out $100,000. I submit a withdrawal request to take out $100,000. And then I submit subsequent withdrawal requests to take out the rest of the $1 million that I have in. I've never seen a dime, and none of those withdrawals have been redeemed. And then just recently, about a week ago, in fact, when we were in Denver, actually, I received an email that the CFTC had charged the individuals that were involved in this as a Ponzi scheme, and all of their accounts have been frozen, and so this is gonna not end well for Pace or I and other friends. We have other friends who I won't name. One who has an additional $3.5 million, another who has $3 million in it, and these are sophisticated people, right? Like these are people that they were able to make millions of dollars. I mean, I don't consider myself a dummy, but I do feel dumb. I do feel very dumb because I should have done more due diligence. You know, I allowed myself to get sucked in based off the relationships that I had And I thought that everybody that was involved, when you think of somebody that it has a large influence and is well known, you almost feel like they're too big to screw you, right? And that's never the case. I am just completely ashamed. I feel terrible that I put myself and my family in the situation where I lost $1 million of our nest egg. And I learned a valuable lesson, and it's to do a lot more due diligence and never to trust anything that seems too good to be true, because at the end of the day, it very likely is.
I just want to give you a hug.
Thank you, Kathy.
Yeah, I'm very sorry to hear that, Jamil. It's really unfortunate, and I'm sorry to hear that you're going through that. We appreciate you telling this story to help raise awareness to people about what is going on. I mean, frankly, unfortunately, this is not the first story about a Ponzi scheme or a scam impacting real estate investors I've heard over the last, 2 or 3 years. Have you heard anything else like this, or did this really come as a surprise to you because you hadn't heard of similar scams before?
Well, for me, I think I've heard of scams, right? I mean, I'm a fan of watching American Greed. I watch the show just because it's interesting to see and hear all these people who would gamble their lives away for a quick buck, and so I watch it just out of curiosity. But so I know scams exist. It's just that I didn't think that they were that close to me, and I didn't think that the people that I knew and that I liked and that I trusted would be involved in them. That to me is the part that's the most hurtful, because I trusted the people involved. I truly did. I truly believed that they had my best interests at heart, that they were friends, and then I come to find out that these individuals, they all profited off the $1 million that I sent in. Everyone was paid referral fees on my money.
Wow.
And it's like, gosh, now I can sue everybody. I'm definitely going to go to law enforcement, and I'm not going to stay quiet about it. I'm not naming names right now, but if anyone has or wants to know any more information, by all means, send me a message offline, and I'm happy to share details in greater detail. But until this situation is completely resolved, I have to be mindful of the legalities involved in the sensitivity of the situation. But I won't stay quiet. I'm not going to be a silent victim.
Yeah.
And I think that's one of the things that these people are banking on, is that the majority of people they feel so ashamed for being duped that they don't say anything, that they don't come out, that they don't share. And I think also that they looked at Pace and I as having such big profiles that they thought these two would never share with the general public that they were duped for $1 million each, because that'll just make them look dumb.
Right.
So I think these guys would be a great target.
Right.
But I'm not. You know what? I'm happy. Call me dumb. But you know what you're not going to call me? You're not going to call me a victim.
Jamil, your friends, do you think they knew it was a Ponzi, or do you think
Yes.
they were even, they did
100% they knew it was a
Ouch.
Ponzi scheme. Absolutely, they knew it was a Ponzi scheme. Everybody involved knew it was a Ponzi scheme. They were all taking fees. If you're taking fees off of my money and there's been no returns generated, and I heard that the fees were like upwards of 20%. So if I send in $1 million and you get 200 grand of that and nothing has been generated in profit yet, how is it not a Ponzi scheme?
Oh, that's coming back though.
Yeah,
Anybody that made money on this will be giving it back.
they'll be forced to pay it back.
Well, it sounds like you know that from experience, James. So James or Jamil, yeah, sorry to hear that. And again, Jamil is being wise because this is an ongoing investigation and not publicly discussing some of the details. But as he said, if you want to ask him about it, he's been very open about that, and we appreciate that. James, I know you've also unfortunately been a part of a Ponzi scheme unknowingly. Can you tell us a little bit about that?
Yeah, I mean, I guess it kind of starts out very similar to what Jamil said, and it's, I was approached. So I had a good friend of mine meet somebody down in California, Beverly Hills, and actually I can talk about this guy because he just got sentenced to 20 years in prison.
Let's name some names. Who do you got?
We'll get to that. It's and so he calls me up, and he says, "Hey, I met this awesome entrepreneur. He just sold his business to Howard Schultz. And he's been relocated out to Beverly Hills, and they are in the film business. And their business is locking up after movies get produced, they get released. Then they go onto the secondary market, and they would go secure the rights for these contracts and then sell them off to Netflix, Sony, whatever all the streaming channels were. And they had a group of channels that they were working with. When at the time when my buddy approached me, I actually told him I just wasn't interested because we were flipping homes and we make pretty high returns, and I like making money on stuff that I control. I don't like giving up a lot of control on these things. But he really gave me a hard press, and not because he was trying to get money out of me or like trying to manipulate. He just really believed in it. And so I flew down. The first red flag was this guy named Zach Horowitz. They took me out. And they flew me down to Vegas on a private jet. And he rented this huge suite, and they took us out all weekend. And he never asked for money at this time. But it was about setting the presence. And he was a very personal person. Actually, I really liked him when I got to hang out with him. Seemed down to earth, was engaged, had all the right story. I got his whole background story because I really like to get to know people before I invest any money with them. But the issue I was having was the collateral. I didn't like the collateral. I was going to give them money on rights to a movie. I don't know what to do with that contract. It's like, and so anytime I'm investing in anything, I'm looking at what's the collateral, and if something goes wrong, what can I do with it? And the only thing I knew what to do with rights to a movie was really use the bathroom with it. I was like, what do I do with this? And
you weren't going to make your own movie and star in it?
I didn't have, and these were all in Spanish too, and I don't speak Spanish. So it's, but so the whole setup was, hey, so you would come in, you'd fund the right to the movies as a bridge lender. Then once HBO and Sony would buy this movie off you, they were going to kick you a 20 to 25% return in a 90-day window, which is very high. That is exceptionally high. Just like Jamil said, we're fighting to make 20-30% on an annual basis and to break our backs. And so what I did is, because I knew the person that was involved, they kind of guilted me a little bit, like, hey, can you help us get this going? And that was the first mistake. Never do an investment based on friendship. You make an investment based on what you're trying to accomplish and verifying the information. The other thing is, I don't like to invest in stuff where people are asking me for money and I don't understand it. Like when I go invest in things, I'm going out and looking in industries that I'm interested in, and then I will find the operators in there. So I end up doing over about a 2-year period. I end up doing about 5 deals with them, and I make about $252,000 in this Ponzi scheme, and I probably put up 250 and I made 250. So I made 100% of my money on these deals that I had done, which was great. But the red flags kept coming to me, and it was really sold to me on a friendship. Like, hey, these are great people. But where I was seeing the mechanical breakdown was, I started noticing their paperwork wasn't in line. Like, for the amount of money these guys were saying they were doing, because this Ponzi scheme ended up getting shut down for $650 million is how much this thing raised. And when I got their paperwork, it was like elementary. It was not done by attorneys. You could tell it was not. They didn't have their securities, their Reg D filed. There was all these red flags, and my friend, my buddy was just like, well, he's just busy. He's an entrepreneur. No business runs that way. If you're raising $650 million, you better expect to be able to talk to a securities attorney. And I asked to talk to their securities attorney, and I got kind of the push around at that point. And so the paperwork was bad. The timelines were a little weird. And then in addition to